What's up, everybody? I am Jaspreet Singh, and market crashes and recessions are bad news and scary events for the majority of people. However, for the minority of people, market crashes and recessions are great news because they create opportunity. That's why market crashes and recessions create more millionaires than any other time. And now, if you take a look around you, you'll see the markets are crashing, crypto is getting hit, you're seeing inflation still running wild, and now with the looming fears of a recession, the question is, how do you find the opportunity now, and how can you be one of the people that become a millionaire in this next phase of the economy? It ultimately comes down to one thing: buying good assets at a discounted price. Because when you have these types of market crashes and recessions, you see some bad assets come out. You see some bad companies, you see some bad investments, and these things cause the price of all assets to drop. Now, assets are things that people buy for the sole purpose of making money. And now when these asset prices drop, it's like Black Friday for investors. Now you can come in, find some of these investments at a discounted price, and then ride up the wave, but it requires the patience and it requires the right financial education. This means looking at potential assets like stocks and real estate and cryptocurrency and businesses and even physical gold, finding the right opportunities here, buying them when they're on sale. That way now you can make much bigger profits. I gave this example in a recent video, but an asset is something that you buy for the sole purpose of making money. And let's assume that in this case, this asset is a box that produces $1,000 a month. Now you can replace this with whatever asset you want that I just discussed, but if it pays you $1,000 a month, the question is, how much money do you have to pay to buy this machine or this box that's going to pay you $1,000 a month? Is it going to cost you $1 million? Is it going to cost you $200,000? Is it going to cost you $100,000? Well, this is what depends on the economy. The worse the recession, the worse the market crash, the cheaper that you can buy this. When the 2008 crash happened, you could buy real estate investment properties in some areas, like in Michigan, that were paying you $1,000 a month for under $50,000. I'm not saying we're going to see a repeat of what happened in 2008, but you need to be able to find the opportunity, and there's 5 different types of opportunities that I want to go over, which brings me to number 1, talking about the opportunity in the stock market. Every time you hear of worries about the economy, the first place where you see this in the asset markets is in the stock market, because the stock market is very liquid. You can buy and sell a stock in a blink of an eye, and this makes the stock market very volatile, because now when people get worried about a recession or an economic slowdown or a potential market crash, what do? They panic, they fear, and then they sell because they get worried. Now, the first thing that I want to say about this is that no good investment decision is made out of fear. No good financial decision is made out of panic. So this is where you want to calm down and understand what's going on, because when people start to panic, they start to fear, and they start to sell, this pushes the stock market down. And then as the stock market goes down, it further spirals that fear and that panic, because now people see their stocks going down, and now they're like, oh my God, the world is going to end. They need to get out of the stocks as fast as possible. So then they sell, and this pushes stock prices even lower. And that's where the media comes in, and they talk about how the world is ending, how the stock market is plummeting. This causes more fear and more panic, causing more people to sell. And this is what causes the stock market to get oversold. You see the same thing on the top. When stock prices are going up, people talk about how much money they're making. They're getting very excited. They get greedy. They start buying more. This is when the media comes in and they talk about how everybody is getting rich by buying stocks, how the stock market can't be slowed down, how the economy is so robust. This causes the stock market to go up even more. And now people are buying not because they believe in the asset, not because they believe in the company, but because everybody's making so much money in the stock market. So you keep buying, and this is what causes the stock market to be overbought. This is what creates our boom and bust cycle. You have this greed, you have this FOMO, and this emotion fueled by everything going on in the media helps to drive these booms and busts in the stock market. And then you can add in all the free and cheap money through the inflation and stimulus by the Federal Reserve Bank, and that makes the bubbles so much bigger. So now, what does this mean for you? The stock market is a place where now you can invest in companies that make America America. And now you don't have to do any of the work when you invest in these companies, but what you need to do is make sure you're investing in a good company. That means that when we see these types of market slowdowns, when we see these types of recessions, you see companies start shutting the doors. You see companies start doing layoffs. When this happens, those companies that are shutting their doors, that are doing layoffs, start to go down. These are your toxic companies. These companies that have to go into bankruptcy are the toxic assets. And these toxic assets cause the price of good assets to also go down. Because when a bad company fails, people get worried, what happens to my company? Is my good company going to fail as well? And this bad company causes the price of good companies to go down. This is where you want to come in, find the good companies and be able to buy them at a discount. Now the question is, how do you find the good companies? Now this has to do with that sort of fundamental analysis, the fundamental research, where now you're looking into the actual numbers of a company. You're looking at the revenues, you're looking at the profits, you're looking at the executives, who runs the company, do you believe in them, do you trust them, do they do a good job? You're looking at the products, are they innovating? And you want to look at the growth and trajectory of their products. And then you want to look at how needed is this product. Is this something that people are going to want next year, in 5 years, and in 10 years? Or is this something that is a dying company, a dying fad? And this information is all public. You can go to a website like seekingalpha.com. You can go to yahoofinance.com and start researching all this data. But if you don't want to do all this research, then you can just invest your money into an ETF. An ETF is an exchange traded fund, and this is now a group of companies where now you're not just investing in one company, but maybe investing in 500 different companies through this ETF. And so you have ETFs that give you exposure to the 500 biggest companies on the stock market. You have ETFs that give you exposure to tech companies. You have ETFs that give you exposure to dividend-paying companies. You have ETFs that give you exposure to emerging market companies overseas. You have ETFs that give you exposure to healthcare companies. You have ETFs that give you exposure to consumer staples, which are the companies that create products that people need, not that people want. And so you can figure out where it is that you want to invest. I made other videos on my channel talking about what type of stocks and ETFs you want to invest in a bear market. So I'm not going to go over all of that in this video. But what I want to get at is when you see these types of market crashes, stocks are always the first to be hit because they are so liquid and because fear and greed can drive stock market prices in the short term. Now, over the long term, it's fundamentals and it's financials that drive the long-term health of the stock market. But in the short term, you have a lot of short-term volatility that's driven by fear and emotion. And this is where now you can come in, find the opportunity, and buy good assets when they are cheaper. Now, if you don't want to put in all that work to find the good assets when they're cheaper, at the very least, you can do a dollar cost average system where now every week you're just buying a little bit of the ETFs or companies that you want to own. There's a bunch of different stock brokerages out there that will do this for you for free. You can check the description of this video to see some of the recommendations that I have, but there's a bunch of different stock brokerages out there that will allow you to do this sort of passive investing. I have this type of dollar cost average system set up where every Wednesday, doesn't matter what day you pick, I just picked Wednesday, but every Wednesday I have money leaving my checking account that's automatically invested into a number of different ETFs that I want to invest in, and this happens whether the market is up or down. It does not change. This is a passive strategy that does not change with the markets. The only strategy that changes with the markets is an active strategy where now you're looking for the opportunity, and when things go cheaper, that's an opportunity for you to come in and buy, but you don't want to buy at one time. I recommend buying in phases because nobody knows when the bottom is. So what I like to do is I like to buy in phases. When I find the assets that I like that are falling, well, that's when I come in and buy. If they fall by another 10 to 15%, I'll buy more aggressively. If they fall by another 10 to 15%, I'll buy even more aggressively. I call this drip investing, where now I'm buying in phases on the way down because nobody knows where the bottom is. And so it's something that you can consider for yourself. Now, if you do want to learn more about how to do fundamental analysis of companies, how do you research companies, how do you actually look into the financials, how do you look into the fundamentals, how do you look into the executive structure and the long-term health of a company, well, then you can check out Market Insiders. It's an investing education app that I created where every week you get access to stock market, real estate, and cryptocurrency coaching from expert investors. So if you want to try out Market Insiders for free, you can go through the entire thing, go through all the coaching sessions, go through the previous classes. I'll let you try it out for free with a 10-day free trial, and I'll put the link to how you can do that down in the description below. The last thing that I want to say on this before we move on to number 2 is that you have to have a long-term mindset if you want to succeed in the stock market or any asset asset class, because over the long term, the people that make the most money are investors who invest for the long term, not just short-term traders. And so you have to have that financial focus and not get carried away by the day-to-day swings. The second way that you can build real wealth during a recession is by buying real estate, not for yourself to live in, but as an investment property. So many people became multi-millionaires after the 2008 crash because they started buying real estate at the bottom after the 2008 crash. That was when I started investing in real estate, because after that crash, you were able to buy real estate for literally pennies on the dollar, because nobody wanted to buy real estate, but everybody wanted to sell their home. They wanted to sell their property. So what you're doing here is you're looking for an asset that's getting beat up and that's getting hit hard and that nobody wants to own anymore because they don't believe in it, they got burned by it, and they want to get rid of it as fast as possible. When you have a mass amount of people that want to get rid of a certain asset class, whether stocks, real estate, crypto, whatever it might be, this creates opportunity for you if you can find the good and right assets, because now everybody's trying to sell them. They're all motivated sellers. They're willing to sell it at a huge discount, and now you can come in and buy. This is what allowed me to buy my first real estate investment property for $8,000 out of foreclosure from the bank, because the banks just wanted to get rid of homes. Now, again, I'm not saying this is what's going to happen again now, but what I'm saying is you got to look for the new opportunity, because while history does not repeat itself, it does rhyme. And so you want to understand how this whole cycle works. That way you can find the new opportunity. And then when you see the opportunity, you can take your cash, and instead of just keeping it in the bank and instead of running away like everybody else, you come in and buy. So you do what the majority of people are not doing. Let me start by doing a brief 30-second overview of how real estate investing works, and then I'll talk about the things that you need to be aware of. So real estate investing works like this. You buy a home or an apartment complex, whatever it is, not for you to live in, but for you to rent out to somebody else. So let's say you can buy this home for $150,000, and now once you own this asset, you can rent it out to somebody else for $1,500 a month. And yes, these types of deals do exist today. Just look around the Midwestern part of the United States. You'll find these deals all day long. So you find this home for 150 grand, you rent it out for $1,500 a month, then this $1,500 a month will pay for all of your expenses, and then we'll put another $300 a month in your pocket in profit, and this would be on the low end. You'd want a little bit more, but let's just assume for the purposes of the example, let's only put in $300 a month in your pocket. So this is how general real estate investing works. When you start to see an economic slowdown, then what that means is companies are shutting down. If companies are shutting down, people are losing their incomes and people are over leveraged on their homes, well, that can make it difficult for people to now continue making their home payments because they have no income coming in. This might incentivize some people to sell. Maybe they're going to want to downsize. Maybe they're going to want to rent. Or maybe they just won't have the ability to make their home payments anymore. And that creates more foreclosures because now banks are coming in and they're taking homes away from people. If banks are coming in and taking homes away from people, this creates an influx of sales of homes because now banks have all these homes on their balance sheet, and banks don't like owning assets. They just want to be in the business of lending money. So when banks own homes because of foreclosures, that's when they want to start liquidating them, and this increases the supply of homes. The price of anything is based on demand and supply and demand. So up until 2022, the middle part of 2022, the demand has been skyrocketing for homes because mortgage rates were at the lowest rates ever. And at the same time, people wanted to buy a new home because of the new work from home dynamic. And people had cash because they were able to save money, not by going into work, by not traveling, by not doing anything during the whole pandemic. So people were making money, getting money from the government, having little expenses. So people had cash and they wanted to spend this money to buy a home, while at the same time, supply was very low. You had builders struggling to build new homes. You had all the labor issues. You had the supply chain issues. So it was very difficult to build new homes. So you had low supply, high demand, and this is a recipe for pushing home prices up. Well, now that mortgage rates have been skyrocketing, the demand to buy a home has been kind of flatlining. It hasn't really gone down, as in like there's no more demand. I mean, demand has cooled down, but there's still high demand. However, now we're starting to see supply start to go up. So we're starting to see this inverse, and along with that, the much higher mortgage rates are pushing demand down, and this is why you're starting to see home prices get cut. Because homeowners are saying, oh, I listed my home for $450,000 and I got 0 offers. So now I have to list my home for $430,000. Now still, this $430,000 list price is probably 100 grand more than what somebody was willing to pay for that home just a couple years ago. But this is the market that we're in, where now the demand is starting to go down. And if the economy gets worse, and if people start to lose more of their jobs, and if people cannot continue making their home payments, well, then that can push more people to want to sell their homes. And that would push the supply of homes up. And if interest rates continue to rise, that would also push the demand for homes down. And you can start to see now, if you have a higher supply with lower demand, what is that going to do with home prices? Well, ultimately, it would have to push home prices down, because if you have people selling their home but nobody willing to buy the home, well, then home prices will have to go down, because now the sellers are going to be competing against each other to get their home sold. Because up until now, it's been buyers fighting against each other. Buyers would have to bid against each other. They'd have to fight to get homes. They'd have to give a whole bunch of perks like no inspections to buy a home. Well, if that flips, where now you have a lot of supply and no demand, well, then now the sellers have to compete against each other through prices to compete to sell their home. Now, again, there's a big difference between what happened in 2008 and today, but this is something you want to be aware of. If real estate prices start to go down, that can create an opportunity for you to come in and buy some real estate at a discounted price. Third is crypto, and this one is a fun one, because people get very emotional about crypto, and their emotions are driven by the price of crypto. Because when crypto prices are high, everybody says that crypto is going to take over the world. This is the next thing, that this is the new internet, that everybody needs to adopt and use crypto. But when crypto prices are down, everybody flips and they say crypto is a scam, it's a Ponzi scheme, it's fake, it doesn't exist, it has no value. And this is where now you have to draw the line, and you have to understand, what does cryptocurrency mean to you? Now, unlike stocks, unlike real estate, unlike gold, unlike businesses, crypto hasn't been around long enough to really prove its value. It's still in that speculative state where we don't know what crypto is going to be. Is cryptocurrency what the internet was back in 1999, or is cryptocurrency what tulips were in Netherlands when the tulip bubble was happening? So you have to first differentiate that for yourself and understand, do you believe in the value of crypto? If yes, then you want to find the right cryptocurrencies for you, because the reality is there's a lot of crap coins out there, and those are a byproduct of the bubble economy that we have seen between 2020 and 2022, where the Federal Reserve Bank and the government essentially inflated and stimulated our economy back to where we are, which created all these bubbles, which are now being burst. And so if you do believe in cryptocurrency, well, then this can create opportunities for you, because when you have such a speculative investment, well, it's going to create a whole lot of volatility on the way down, because now when the bubble bursts, as you start to see more cryptos fail, as you start to see more exchanges fail, it's going to create way more panic, way more fear, and that's going to cause the prices of crypto to go down, and you're going to see way more crypto haters pop up, even more than what you're seeing now, and this is going to push the price of crypto down. But again, if you believe in the long-term value of crypto and you're willing to take that risk, well, then that can create a buying opportunity for you for the long term to invest in some of the cryptos that you like and that you believe in. I invest in cryptocurrency. I believe in the long-term value of the blockchain. Now, I'm not investing in all cryptocurrencies. I'm investing in just a few. I invest in Bitcoin, Ethereum, and a couple of the smaller ones, but that's it, because that's what I believe in. Now, I understand that it's risky and that it's speculative. That's why it's a smaller piece of my portfolio, but that's what I understand, and that's why I'm willing to invest in it, because I do believe in the long-term value of the technology behind what the blockchain can do. Now, on the other hand, if you don't believe in cryptocurrency, if you don't think it has any value, if you think it's a scam, you think it's a Ponzi scheme, then don't invest in it. The fourth way that you can build real wealth during a recession is by looking at businesses and either buying or building a business. Some of the biggest companies that we know today, from Microsoft to Uber to Airbnb, were all started during a recession. Now, when most people think of a recession, they think of the world ending, the economy shutting down. But for some people, like the minority of people, the people who think different, it's an opportunity for you to innovate and create something that the world needs, because this is when the world is going through a huge economic shift. Now, if you're not willing to or able to create a business, the next best thing is for you to purchase a business. Now, of course, this takes more time, effort, and labor on your part, because you're going to have to actually buy a business. But this is where you have to decide if this is something that you're interested in, because when you go through these types types of market slowdowns, these types of recessions, these type of market crashes, then what happens is the people who are over leveraged, the people that can't manage businesses, these are the people that start to get burned, and they're the people that will need to sell, and they will be willing to sell it at a discount because they become motivated sellers. An easy example that I can give you, or more of a personal example, is because I invest in real estate quite a bit, and after the 2008 crash, what you saw happen was the stock market bottomed in 2009, and then the real estate market continued to go down until 2012. 2012 was when the real estate market bottomed, and 2009 was when the stock market bottomed. By 2012, the stock market had fully recovered, and the reason why is because, well, the real estate market is much slower moving, the stock market is liquid, so it can crash and rise very quickly. But what happened after 2012 was you had a lot of people who owned your larger real estate properties, your commercial properties, that then really started to face issues because you had these people managing apartment complexes that were overloaded on debt and they didn't know how to manage the business of the apartment complex. So they were willing to sell their apartment complexes for literally pennies on the dollar because they had no other option. The banks were knocking on the door saying, you need to do something, you got to turn this property around, you got to sell it. And so with all of that going on, there was properties that I even purchased. It was $1 million property that the owner sold for $435,000. And the reason why he sold it was because he had to sell it quickly because the banks were knocking on the doors. He was over leveraged and didn't know how to manage the property. There was ultimately no tenants in this property that were paying rent, and it was in a gray area. And so he had no other option. And you see the same thing happen with businesses where when people get over leveraged, they get excited by the hype of the boom economy, by the bubble economy, they start doing things that they don't know how to manage. And then when things start to slow down, that's when they realize, oh no, I wasn't ready for this. And while it sucks, this can create opportunity because then they will need to get out. And if you don't come in and buy, they're going to have to sell it for an even bigger discount. So this is where now you can look for opportunity to find a business to potentially purchase. And if you don't want to run a business, well, then you can also look at investing in some of these businesses outside of the stock market. Like with the whole equity crowdfunding market out there, well, companies can now raise money from regular people like you, and now you can invest in startups without having to go out and find these startups because you have platforms like WeFunder, Republic, and Start Engine, which let regular people invest in startups. Now, I do got to let you know that I am an investor in WeFunder, but I'm telling you this just because now you have the ability to invest in startups and you have the ability to invest in companies that are looking for money. And when you go through these types of market slowdowns, well, then valuations go down, even if there's a good company, because people are looking for safer investments and they're worried about the growth of their investments. And the fifth way that you can invest your money is by owning some physical gold. Now, I don't consider gold an investment for me. The gold that I own is another way for me to save money. I look at gold like real money, physical money, because gold is more of a store of value. It takes time, effort, and labor to mine an ounce of gold, and this effort, time, and labor to produce gold is represented in the physical bar of gold. So for me, gold is that physical money, it's that store of value, versus the paper dollars is more of a currency for money. It's a way to exchange. And so for me, I understand the value that gold has, but the reason why I'm talking about gold today is because the recession and the economic worries that we have right now are very different than what we saw before the 2008 crash and the 2001 crash and all the previous recessions, because right now the recession and economic slowdown that we're facing is due to inflation. So what that means is we have all this money printing that happened, which is reducing the individual value of the dollar, causing the price of things to go up, causing spending to go down, causing this economy to slow down. And so because of that, the Federal Reserve Bank is working to now fight inflation to help cool down inflation, to help save the economy. However, I don't think it's going to be a very easy fight to fight inflation. I don't think it's going to be a very easy fight to save the economy and inflation at the same time. And if the Fed starts to reverse the fight on inflation to help save the economy because they say, okay, inflation has cooled down from its highs. However, now we're seeing much more layoffs. Now we're seeing much more issues in the economy. So we need to ignore this inflation issue for a little while and start inflating and stimulating the economy to save the recession. Well, that's going to make the inflation problem worse. That's going to devalue the dollar more, and that would make assets like gold become more valuable. Now, the reason why I don't say gold is an investment is because gold doesn't really produce much value. Like real estate produces value because somebody gets to live there, they have a roof over their head, and they pay you rent. When you invest in stocks, it produces value because if you invest in the Amazon company, well, Amazon is working to improve their infrastructure. They're actually producing a product and a value that people need. If you invest your money into a business, a startup, it's the same thing. You're investing your money into a company that can use your cash to help grow. If you invest your money into cryptocurrency, you're investing your money into a software and a technology that you hope will provide more value, versus with gold, it's just a bar that sits there in a closet or a drawer or a vault. So it doesn't produce any value, but what you're trying to do is you're trying to store the value of your money by purchasing physical gold. Now, of course, gold is volatile, but it provides you a different way of saving some money, and this is why I own some gold. It's a small piece of my portfolio, the smallest investment that I have in my portfolio, but it's an alternative way to save, and it's kind of like an insurance against worst case scenario types of situations, and it protects you against higher inflation. If you enjoyed this video and you want to see why we might be entering a once in a lifetime opportunity to build wealth, I already made a video covering that, and you can watch this video by clicking this button right over there. Thank you for watching, and as always, keep hustling. If the government wanted to spend more money and they didn't have the ability to just print money out of thin air, if they couldn't work with the Fed to print an unlimited amount of money, what would they have to do?